So we'll get started. So how many of you have been to any kind of an education seminar on long-term care? Anyone? Once? Did you did you learn a lot? Yeah. Well, the main thing to know, I see some of you guys look like you're pre-retiree and some might be retired, but it is something you have to actually, I'm not going to call out people's names, but I will say I am 50. And at 50, you have to start thinking about it. If you're going to have all the options available to you, 50 is the time to think about it. And I've told my staff, I said, between 50 and 55, I'm going to get my policy in place because it's so much less expensive if you get it in place before 60. So this is the perfect time for a lot of you to just look at it. If you're already over 65, it is still very affordable for some kind of coverage or options up until about 73 or so. After that, it kind of takes insurance off the table and you have to look at one of the other options. And then, of course, if you don't have much as far as options and finances, it's really important to have a runway of 2 to 3 years to prepare if you're trying to get Medicaid, which in California is Medi-Cal, to help you or your family members with any kind of in-home or in-facility long-term care because there's a long, long wait list. Has anyone known anyone that had long-term care paid for by Medicaid or Medi-Cal or gone through the process? I will tell you, clients tell me about it because we obviously are not Medicaid providers. I don't do anything with them. But it is usually 2 to 3 years. It is multiple applications. It is certifications. It is waiting lists. So if you don't start the ball rolling before you need care, it could be too late and then you have no other options available. So thank you for being here. I hope it helps you and your families. So these are just some facts. These are not fun facts. I will tell you, out of all the talks that I do at the education talks, and this is my least favorite one because it's not fun to talk about it. Does anyone say, oh, I cannot wait to use a walker? I can't wait for those hip replacements. Nobody wants to talk about it. It's worse than talking about life insurance. And that's because these statistics really suck. There's nothing fun about it. And the average cost is over $100,000 a month. And I'm going to tell you lots of stories from my real clients because out of so many decades, over 100,000. And that sounds like a lot, but I had a client and she's on hospice now, but she had retired. Her husband died of cancer, so it was just her. And she had about 3.5 million. That's a lot of money, right? So she ended up doing the self-insured, but her sister's taking care of her and she started to get Alzheimer's. So she started to need memory care, which is the most expensive kind. Does anyone not know what Alzheimer's or memory care we could, because you have to have 24-hour monitoring. So we started taking withdrawals from her IRAs and they started out at about 12,000 a month. As she declined and needed more care, and now she's in hospice and being fed by a tube, she's just hanging on. But we were taking out $18,000 a month to pay for her care. 18,000. How fast would your savings go down if, besides your regular, let's say we're married and you have to go into a facility and I stay at home. Do my bills go down by half? No, I still have the house. I have to pay for insurance. I have to pay for your car insurance, still for your car. So my bills don't go down and I still have to pay an extra 100,000 out of pocket. Do you have an extra $100,000 a year that come in that you go, I have nothing to spend this on, so I can't wait to give it to the facility. So that's a really daunting number for really basic places that just have your room and board, no medical care. Maybe they'll help you like dressing or something like that, but no medical care. You're talking at least $3,000 to $5,000 a month just for your rent for a studio. It might even have to be shared. So it's very, very expensive and it can add up quickly. Medicare, people always think about that because Medicare will pay for your long-term care. Did you know that? For 100 days. So for about 3 months, they will cover those costs. But your copay to Medicare is $200 a day. So that is $6,000 a month for your 3 months of long-term care. Again, that's your copay. So very expensive, even with Medicare. After that, they just put you out. They will not pay for it for more than 100 days. 70% of us are going to need long-term care of some kind. And that might be a shorter term or longer term. And we don't know, but 70%, that's a very high percentage. If I had that odds in Vegas that I was going to win 70% of the time, I would be betting very, very heavily on that. So if you look in this room, I mean, that would be everyone but 2 people are going to need long term care. And then the average need is 3 years. And that's because Alzheimer's and memory care patients usually only last about 2 years. If you have, and diabetes isn't very long once you start needing a lot of help. But if you have something that's just like a hip problem and you need mobility help, you might live a long, long time and still need care. And even if you have a partner, my husband was in a terrible, terrible car accident, an RV accident, actually 2.5 years ago, and almost died. And his arms were cut off and his hips were crushed. So they put the arms back on, but they were in those like splint things with these vacuums. So he couldn't do anything for himself for months. So I had to have a caretaker because even when I was home, do you think I can lift up a 180-pound dead weight and put them in the shower safely? I might lift him up, but he's definitely going to be dropped. So you have to, even if you want to help your partners, if you're in your 80s, you can't help your partner. So you have to think about another option. And you can have different kinds of care. So most people like to have care at home. That's having somebody come to your house, do the care things, and that's the most common. So most people need help dressing, bathing, toileting, and if you plan those things, you could have somebody come in the morning for a couple hours and then the late afternoon for a couple hours and be taken care of and stay independent other than that. So there are different kinds of needs that could make it so you could stay at home. And if you know somebody like that, it's relatively easy to find people that want part-time job as a caretaker and make sure that they have some kind of training. And I found mine for my husband on care.com. It was much more reasonable than a agency and she was lovely. So if you find the right person, you can have that kind of affordable quasi care that you don't have to go and spend an arm and a leg for and not have to go to a facility. But once you're accepted, also once you're accepted into a nursing facility, even if you run out of money, usually it's very hard for them to get rid of you. That's why it's very hard to get into them. There's these long waiting lists, and if you're not going to a Medi-Cal or Medicaid facility, a lot of them, the best ones, of course, don't accept Medicaid. But the ones that are private pay, once they accept you, still it's very hard for them to get rid of you if you do spend down your assets. So they'll want to see if you're going to apply for a nice one, they want to see all your assets. They want to make sure that you have enough money to pay for this for a long time before they let you in. And that's just normal because you're going to have that payment until maybe the rest of your life. And then most people need care around 80 to 85. And that's just when things start to break down. So there's 3 stages in retirement. There is the go-go stage, and this is universal. I'll always tell you if something's my theory or what I've seen, but then there are universals. This is universal. The first stage is the go-go stage, and this is the fun stage. So you just retired, and all I hear is, I've always wanted to, and it'll be something like, go on a safari, go on a world cruise, do something. So almost, I still have some to say, I just want to sit at home and watch Netflix. And whatever it is, they've always wanted to blank. That's the go-go stage. And you start checking things off that list, seeing your friends, going to Bunko, picking up your pickleball game, which I heard is really fun, and doing all those things. Then, huh? It's a racket. That's right. That's right. But you can tell these guys play. So exactly. But then something happens, usually in the late 70s, that turns you into the slow go stage. And the slow go stage is, oh, my knees hurt, my hips are hurting, and I'm so tired. It's nothing that's urgent, but you just don't feel good. And an example of that is my dad is 79, and for the last 2 years, and he is obsessed with my 3-year-old. I mean, they are best friends. They talk to each other every day. And he used to come out from the East Coast 3 or 4 times a year. He hasn't been out in almost 2 years. And his reason is he's just too tired. And I know he has aches and pains. And this is what happens to everyone. So he just entered the slow go stage. So then he always comically says, well, he doesn't think it's funny, but why don't you just come out here for the weekend? Okay, I will take my husband in the wheelchair, my daughter, my son, all of them as I work full time, and we'll just get on 2 planes and go to Wilmington, stay for 2 nights, and then again, get on 2 planes, push his wheelchair, and come back. Too hard. So you'll enter the slow go stage. And that's when some of these needs are going to start because those aches and pains will turn into injuries or illnesses will start. So something will happen then that changes and moves you into the no-go stage. This is the no-go stage, and that's something physical happens and it makes it so that you need care or you just aren't able to go around and do things for some reason. So the no-go stage starts usually somewhere between 80 and 84, something happens. I'm sorry that I'm in your way, but you do have all the slides there too. So these are the only 4 ways to pay for long-term care. And they're all good options. It really just depends on the person. I'll give you examples of who would be good for any of these, and we'll go over each of them. Medi-Cal. So 42% of all Americans use Medi-Cal to pay for their long-term care. They just changed the rules for it last year. They're still evolving. So currently, this is what we have. And we gave you resources in your handout sheets of attorneys that deal with elder law and Medi-Cal law. If you think that you're going to try and qualify for Medi-Cal and you have any income more than Social Security, I would definitely recommend contacting an attorney before you just reach out to Medi-Cal on your own, because the immediate answer to almost anyone who's not very, very low income is no. But you can push it through and get exemptions. There are waivers, but you would need to just talk to an attorney. It's free. So I don't recommend any of these. I don't know them. We tried to do some research the last month and do interviews. It was hard for me to coordinate schedules. So I just wanted to give you the resources, not endorsing, but we did speak with them and they seemed friendly, responsive enough so that I could put them on the list of local resources. And then the other one on the ALW waivers, most people, when they have something happen, they don't say, oh, I can't wait to move to a nursing home. Nobody wants to move to a nursing home. So the first thing that you usually need is some kind of home care. So Medi-Cal, which is for the lower income, is Medicaid, but for California. Every state regulates their own Medicaid program. So for California, it's Medi-Cal. They offer an in-home care or assistance of different levels. I put all of those are free resources on how to get home care. So you'd contact one, and I would contact more than one. They all look like they're different. This is I forget which website I grabbed this, but it was a senior citizen nonprofit. So again, I don't endorse any of these, but I think these are mostly government programs. And then they all are for help in the home. But if you're looking for something that's going to pay for you in a facility, I would contact an attorney about qualifying for full Medi-Cal assistance. And this is what's interesting. So your assets, if you looked into it before, you had to spend your money before they will help. Now that's not the case. You can have as many assets as you want. You could have 3 rental properties, $1 million in IRAs, and still qualify. It's all about your income now, just your income. So to qualify for regular Medi-Cal, you need to have an income of less than $1,732 before taxes, and as a married couple of $2,352. However, one of the other things is if you are looking for in-facility nursing care, you actually can have any income now, but you need to give all of your income to the government, or actually to the facility, and you can keep, look how much you can keep per month. It's right here. $35 per month, not per week. That's, you get 1 trip to Starbucks for 1 coffee and 1 food item. That's it. And per month. Now, if you are married, You can keep slightly, and so again, we're married and we each have $3,000 of Social Security, and you're going to go to a facility and Medi-Cal facility. I, as a spouse, not going or needing aid, am entitled to keep almost, it's 3,900 something. So $3,900 I'm allowed to keep. If your social is 3 and mine is 3, I'm allowed to keep 900 of yours. You don't have to spend it all to go. Does that make sense? Normally, if he's going to Social Security Medi-Cal facility, he has to give all of his Social Security or income. He might have IRA income, he might have rental income, whatever income that is, to no limit, he can give to the facility, and he only gets to keep $35. But if I'm going to be an impoverished spouse, is what they call it, I get to at least keep 3,900. So if that means I get to keep some of his income, they will allow that. Make sense? So you are losing all of your income if you're going to be using Medi-Cal. But if you're in that income level, that shouldn't be a problem. Now, if your pensions are $20,000 because you were a high worker and Social Security is $3,000, do you think you're going to want to give all your income and get free care? No, you're just going to pay for your care or do one of the other methods. So this would be for someone who really, they live off of Social Security. Maybe it's a couple, maybe a single person, and maybe they have little IRAs or something. They're not worried about giving all of this money to pay for their care. Now, maybe they don't have a whole lot of beneficiaries, but you don't have a lot of options. You're going to have to spend all of that income on the facility, and they're going to audit you annually. So they know how much you brought in because you get 1099s from IRA distributions, and you have to file a Schedule E for your rental income, things like that. And then here's the other thing. So let's say you were able to say, I have all these assets, all these rental houses, but my family's not paying me rent, so I don't have to claim it, right? Sounds good? Well, any amount that the government paid on your behalf for the rest of your life, when you pass away, that money comes out of your assets. So they're going to get it anyways. So if you have assets, don't use this method unless for some reason there's a valid reason to use it, because they will take it. And then you thought you were leaving $1 million to your heirs, but now you're not, because they'll take it at your passing. Any questions on that? They call it the estate recovery system. So make sure that there are ways, if that was you and you wanted to have Social Security, Medi-Cal pay for everything, but you still have $1 million in assets, talk to an attorney. They can sometimes use special trusts that are protected, but that's, again, talk to an attorney. There are special ways. I did have one client who had that and they were able to keep it. There are wait lists, as I said, 2 to 3 years for all of these things. So the moment you see the need might be coming for some kind of a care, you need to figure out what your options are if it's through Medi-Cal. Plenty of places will have availability today, but they are private pay. And private pay means either you're paying or insurance is paying, but not Medi-Cal. A lot of Medi-Cal also will not pay for single rooms. If you happen to luck out and get one, that's fine, but mostly you're going to be sharing. So if you have the financial means to do one of the other options, you probably will enjoy it better. If you have Alzheimer's, you probably won't remember that you didn't enjoy your place. And I just say that all of us have known someone with Alzheimer's and they're not aware. So you can make that choice. So number 2, private pay. This is really popular because a lot of people don't want to put money aside and for premiums or anything else, and they have enough assets, and they think they're going to be part of the 30% that doesn't need long-term care, so they private pay. Just like that lady I was telling you, that's one of my clients from the credit union that had the $3.5 million IRA. And private pay is fine. If my clients have a net worth of over probably about $3 million, they usually opt to private pay because they have enough money to pay for it if they need to and not impoverish their other spouse. And they like making their returns on their investments. So that's just what they choose to do. So what I tell my clients, depending on your age, that this is how much you should put aside. If you are 50, you need to put aside a lump sum of about $150,000. Or you can save $1,150 a month, and that will give you the equivalent of 3 to 5 years of care of varying amounts of $6,000 to $10,000. And that's starting at 50. Remember, we said that hopefully you start thinking around 50. It all kind of falls into place if you start thinking about it early. If you wait a lot longer, it's unaffordable to start to use a lump sum or self insure unless you have a lot of savings or you've inherited money. I have clients who do. They sell. I had a client last month. They sold their California home and they moved to another state, and they had already had the house in the other state. So then immediately they have $1.5 million with nothing earmarked for it. Piece of cake. We just take a certain amount, put it aside, and invest it. But we know if they need long term care, this isn't going to be touched for regular retirement. It's long term care. And that way it can still grow at a good rate of return and then is held handed down to the kids and if it's not needed. So that's really simple, is the self-pay method. But you want to have a plan. You can't just say, I think I have enough. You have to kind of earmark it out and not touch it and utilize it for that. A reverse mortgage. This is my least popular of clients' options. Honestly, I love this option, but people don't love it. And I think I've had one use it ever. So again, these are totally up to you. This would be great for someone who they have a medium amount of income and maybe they have a pension for $5,000 a month, Social Security is $2,000, and they've got $500,000 in IRAs. So this is not going to be the kind of person that goes on Medicaid, right? They've got money, but are they rich? Do they have enough that do they want to spend all their $500,000 down for care? And again, my husband and I, he's going to go into the facility, and we have $500,000. I don't want to start paying $10,000 a month. That's going to go through our nest egg really quick and I'll have nothing left. So if you're in that bucket, this is a great option for you. You can access a lifetime of payments. As long as one of us still live in this home, they will pay you indefinitely a certain amount based on usually 50 to 70% of your equity. And they calculate it out. I recommend Mutual of Omaha. It's a large company. They're not going to cheat you, very fair rates. But if Mutual of Omaha paid us $6,000 a month for life and your care is 7 or 8, perfect. Now my lifestyle doesn't change. We don't have to spend down our 500,000 and it helps forever as long as he lives, pay that. And you don't have to pay it back. So if both of you move from the house, you do have to pay it back then because you'd sell the house. But that's really the only thing. People don't like it because they want to give their house to their kids and then it spends down some of the equity. But in that situation where I described, which is a lot of my clients from here in Gain, because a lot of city workers and people that have between 250 and 750 in their IRAs, I would keep that money intact and use a reverse mortgage if it was me. Any questions about reverse mortgages? Because I didn't really go down the list. Of a reverse mortgage? So at the end, and you mean the end meaning that you and I both pass away or move from the house. So let's just say, because one of us has to stay in the house. If we move, we choose later to, you're still in the facility, but I want to move to a condo. It's just too big without you there. Then I have to sell the house or pay the mortgage back. But I'm still using the money to pay for your care. So I would sell the house, take the equity besides the money I owe back because they gave me money to give you, and I would buy my condo, and I would still hopefully have maybe 400,000 or 500,000 left from my home sale, and then continue to pay for your care. So when both the second spouse moves out, you have to sell. I think they give you 9 months. Don't quote me on that, to figure it out. But you don't want to cheat the companies. It's fraud. Good question. Any other questions on reverse mortgages? And they'll give you the lump sum, or they'll give you payments. And I always say take payments because then your balance grows little by little versus having a big balance with interest accruing the whole time. Just gives you more options. But I'm happy to answer more questions, and I'll always give out the contact info I have over at Mutual of Omaha if you'd like to get any quotes or anything. And the fourth one is long-term care insurance. Does anyone have long-term care insurance? So I'll tell you, I was around. I was already doing this when really long-term care started to take off, and I think it was in the maybe late 90s. And MetLife was the biggest company. You know, Snoopy, he was the biggest one, but they totally pulled out, and it was really tough on long-term care because people started living longer, and their care was more expensive because they lived longer. They didn't just have a heart attack and die anymore. So all their formulas were not working out. And most of the carriers left the marketplace. But now it seems like things have stabilized. So we have a lot of options now. And we actually have better products. So if you're thinking about insurance, again, you kind of have to be under 75 to have anything reasonable at all. And 80 is the absolute top. No, nothing can be done after 80. After 80, you have the other options. So the main types are traditional pay, then they have a combination life and long-term care, and then there's the annuity type. For me, I'm going to get the combination life one. It's my preference. To me, I kind of consider that the Cadillac, but there's a different kind of client for each one that's the best. So that's why these three are all great options. So traditional, oh, and this is the main thing too. If you are looking at policies, there are cheaper policies that don't include things that you really need. And if someone is selling you insurance, they might just have a quota of how many policies they have to sell or just get you in so they can make some money. But you have to make sure it's going to cover you. Some of the most important things are make sure your minimum benefit by the time that you are 80 is $4,000. If it's not going to cover something that's meaningful, if your coverage is $2,000 and your bill is 8, does that really help you? You're still in the whole $6,000 a month. That didn't really help you. And so you didn't really get insurance. I mean, you did, but it's like insuring your car for 15 and 30, versus I think I have 300. Like, what accident are you going to get into that your damage to your property is 15,000? That's a bumper these days. So same thing. Don't get coverage for something that's going to be less than 4,000. And then don't forget to get a cost of living adjustment, because $4,000 today is not the same as what it will be in 20 or 30 years or whenever you turn 80. So you want to make sure it keeps up with inflation. And then pooled benefits. If you have a partner, there are some policies that let you pool benefits. So, and some of them do recognize domestic partnerships or same-sex marriages. You have to check with that carrier, because if you are in a same-sex marriage, you want a policy that recognizes that. And pooled benefits mean that if my coverage is 4,000 and your coverage is 4,000, that you can go in and use 8,000, and I'll give you part of my benefit. And wouldn't that be helpful? Because really, we're probably statistically good chance that only one of us will need care. So pooled benefits gives you that option to help the other person. Now, it takes away from how much I have total, but it sure takes a burden off of the family. So pooled benefits. And then reinstatements. This isn't one that's not as common anymore. They're not offering it. But if a lot of times people will have like a burn accident or a hip replacement or broken bones that you can recover from, right? Actually, you don't even know, but I have a broken arm right now. If you notice, this arm can move like this, and this arm I can only go like this. But I can't wear my cast with my jacket. So in the name of having it not be a distraction, I didn't wear it. But bones heal, right? So if you have a reinstatement waiver, that means that as long as you don't need care for 6 months, your policy goes back as if you never used care. So it's back to being valid for 3 years and the full amount. So it's as if you never made a claim. So that's really nice. And then there's discounts if you and your spouse or partner apply together. And that's because they find that people that have partners, tend to not need care as much as people that don't have partners. So they give you usually 10 or 15% discount. Now, traditional long-term care. Make sure that you know if you're doing long-term care premiums, they are deductible too. So depending on your age, this is the annual amount you're allowed to deduct. So probably not as much as your full premiums, but they are deductible. And then this is how I have a printout bigger for you in there. This is what a traditional long-term care insurance looks like. Has anyone ever got a quote for long-term care? Good. Okay, so this is highly educational. Let me just tell you how to read this so you know your options. This is somebody, I accidentally ran Arizona. So just so you know, Arizona is cheaper than us by about 20–25%. So and when I looked at it this afternoon, it was too late for me to rerun it, but I was wondering, I'm like, why was this so cheap? That's because I put Arizona. And this is for somebody who is 51 and their premium would be 185. Remember, for California, it's going to be closer to 250. But look, that same policy, I'll get out of the way. If you had started it at 62, look at what it is, 305. So, and you pay this for your whole life. It's just like auto insurance. You have the coverage when you pay it. And if you stop paying it, you have no coverage. That's pretty simple, right? Just like your auto insurance. But if you start it younger, you're going to pay a lot less. So this is why I tell people, best case, get it around 55. And this would be something that you can see. I said the benefits should start, it should be about 4,000 at a minimum at age 80. If this person at 50 starts it at 3750, and that's the benefit per month. Every long-term care is quoted as monthly benefit. And then it's also quoted as how long is it going to pay that benefit. So it gives you a lump sum that's available. And in this case, it's 36 months. So you can pay, they'll pay up to $3,750 for 36 months. And most of them will let you take a little less than that and let it last longer. But it's just 36 months times $3,750. This one has a 5% COLA. So 3% is usually fine. That's usually what people can afford. Look at 5%. See how much more expensive this is? 404 versus 185. 3% should be fine. Just dollars for dollars, I would probably go with 3%. And you can see that by the time this person is 80, oh, it doesn't even go down that far. This is already paying almost $8,000. So it's going to cover a good portion of what that person needs. And it's only $185 a month. So very affordable. But this inflation is what is the big factor for the premium. So those different premiums there. Now compared to if you start later, it's 305, 393, and 508. And then when that person is 80, that's right here, it's not even as much. Look, 5,200 versus it would have been 7,600. Do you catch that? No?
Don't understand anything about that chart. I can't see you, but where are you? I don't even know what it means.
So this is how much they will pay per month. That's okay. To the facility. So your facility might cost $8,000 a month, but here this person is 62, so this would be 82. If you buy this policy with 3% inflation, then this is growing up by 3%. So if you had a claim right here, this is how much it would pay. But most people don't need it till right here. So this is how much you'd probably be getting per month when you are in your 80s. And then this is just options. You would pick one of these columns if you want. It just gives you 3 different inflationary rates. And I'm saying, if it was me, I always recommend the 3% because it's so much less and it still gives a good amount of inflation. So I go with this column. So this is how much, depending on your age. So she's 62, and you'd say in year 10, she'd be 72. So they would pay $3,913 to your facility. Does that make sense? Any other questions on this page? And it's just a numerical quote, just showing you how they work. And these are the things that we get to put in as far as just the things, but this is pretty normal. And so this would be a good policy. And even at 62, so you're getting ready to retire, $300 a month is pretty good. And that's a good policy. For California, it'd be more like $350. And then if you're married, you get the discount, or have a partner that's recognized, you get a discount. So that's regular, straight, long-term care. You pay it forever. This is the combination of life and long-term care. What I like about this is you can pay for monthly, you can pay annually, you can pay for just 5 years, you pick how much you want to do. A lot of our clients will just put lump sum. They'll put in 60 or $100,000 and it's just a one lump sum. It can be completely refundable. It can earn 3% interest. There's a lot of different options. But this person who's going to go for this person is going to have funds available. Maybe you have assets of 750 or more, but you don't have 3 million. So you want to just designate a certain amount of your assets to just kind of set it and forget it. But you also want to maybe get your money back if you change your mind and not be penalized. So that would be to this person. So this is how you read this chart. Again, this has a 3% inflation. You've got to keep up with inflation. And then this is your monthly benefit. So the main thing with insurance, with long-term care, is the monthly benefit. How much will it help me per month? Because the facility is not going to charge you annually. They're going to charge you monthly. So these all pay monthly. And they typically pay directly to the facility. So you can see this person is 66. And then when they would probably need care, maybe around 82, the benefit's going to be about $6,000. You should have that sheet. Chase, huh? Oh, you didn't? Okay, well, we can print it out. I can email it to you guys if you have your email addresses on here. It's just unreadable? Yeah, I thought you printed out all of the numerical ones. He missed one. Should we fire him? so, uh, so it says that it would be about 6,000. Here's the nice part about this. This is what I love about it, is that this person hypothetically would put in 125,000. That sounds like a lot, right? It is a lot. I think that's a lot of money. But if you're paying as a couple, you're paying, or even it just says one person, you're paying $400 a month for your policy. And in 10 years, so that's $400 a month is $5,000. In 10 years, how much did I pay? 50,000, right? 5,000 a year, 10 years, I paid 50,000. So in 20 years, I paid 100,000, right? Of the other kind. But that is just like your auto insurance. What do you get at the end of that? And you've paid for 20 years from 55 to 75. You don't have anything. It just pays the monthly benefit if you use it. Now you pay for 30 years and I got it at 55. So now I'm 85 and now I'm using it. Now I've paid 150,000 and I don't get anything from it except for this monthly benefit. This I do. So in this case, I put in 125. I know exactly how much I'm putting out, so I just do it one lump sum. My kids or anybody will get that money if I die. So somebody will get that money. It doesn't just go nowhere. And I can get my money back, that's this column, at any time without a penalty, all of it. So that's pretty nice too, right? It gives you the flexibility. Now, most people don't have to put 125. This is just the illustration I ran that came up with these numbers right now. But I had a couple that did 2 of these policies recently. Now they did just retire here and then they moved to somewhere in the East Coast. I think it's North Carolina. And we ended up doing 150 total between them. This is 125 per person. So they did 75 and 75. They are totally covered. Their benefit starts at $7,000 each. And it's a great fit for them because they sold their house here and had over $1 million in cash even after buying their next house. So it was great for them to just say, now that's taken care of. Any questions about this? This is a long-term care policy that happens to also have a death benefit. The death benefit is just what you put in. There's no growth. There are ones that are first life insurance. The other kind I didn't put, I don't want to confuse you guys. So another one that's really popular, I'm going to use this kind. But if I needed death benefit and long-term care, then you use a death benefit type of policy, a actual life insurance that lets you access 3% of your death benefit per month. So if you have $1 million, it'll let you take out 3% a month of your policy. So it'll last for about 3 years. So yes, there are life insurance ones. They're more expensive. I'm just saying for my dollars, I would use the more economical one that's really, it's a long-term care policy that just happens to give you a death benefit of what you put in. So it's all what you want to pay for. Or if you had a life insurance that had cash value and you weren't using it, you didn't need it anymore, you could exchange it into another life insurance that would allow you to use your death benefit for long-term care. So there are those varieties as well. And you can tell too because they're usually, if it's a life insurance that has an annuity, has long-term care, it won't call it a care type product. It'll be life insurance and then that'll just be a rider. This is a long-term care policy. And then there's also long-term care annuities. So for people that are too old to get affordable long-term care, then you can actually buy a fixed annuity that will allow you to access 2 to 3 times what you put in after 1 year for the care that you need. So if you put in 100,000, and you can issue this up to age 80, and you just basically have to not be in a nursing home when you do it. You put in 100, after a year you'll have $300,000 of benefits, and then they'll give you what the maximum is that you can use. But these are the charges for the actual insurance, and this is an example of 180,000, and they will give you $547 in total benefits and a maximum of $6,000 for each, me and my husband, and that's us putting in $180,000 lump sum. So great benefit, more of a benefit than the long-term care one that I was showing you that I would do. But this one has penalties. So you can see there's a penalty if you took your money out early. And then it's only guaranteed to grow a lot for the first year. After that, the minimum is 1%. So again, it's a fixed annuity that gives you 1% rate of return, and then it's going to give you 3 times the benefit in long-term care. So there's no death benefit or any other thing. You're basically going to get your money back plus a little bit of interest if you died and didn't use it. So that's gaining popularity, especially people 75, 76. Insurance is really expensive. Buy a fixed annuity that has this long-term care involved in it. I think the minimum on this is 50,000 to put in, but you can only do a lump sum. You can't make payments or anything like that. Any questions on this? There's only 2 companies out there that do it. No. Okay. So those are the 4 things. Make sure you check all of your options. Make sure that you check with your family. So if you're not sure, maybe you're in your late 70s, you're confused, or you think you know which one you want, but you don't know if you can really afford it, and there's a family member that usually you use to bounce ideas off of, bring that person into that conversation with you, because they might go, Mom, you never have $500 a month that you can spend on long-term care. So for insurance. So we can't spend that. I have to give you $200 a month just to get you to pay your copays. So if you talk to somebody that maybe knows you really, really well, you can also get that guidance to help you make a better decision. And I hope you found this helpful. And I'm here after this meeting if you have any questions. And if you want to set up any time to talk one-on-one, Chase is here and we can set up an appointment. I'm here on Tuesdays and Thursdays, all day here in the credit union. And I'm happy to talk to you about your options and make sure that you make your best choice. Thank you.